Northland Power NPI on the TSX currently trading at a price of about $18.70. Believe it actually ended the session a little lower than that today. Market cap of about 4.88 billion, and they are a power producer in Canada, the United States, and internationally, producing electricity primarily from renewable resources, nat gas, and battery energy storage. As of September 30th, 2025, it has a net economic interest in about 3,014 megawatts of power producing facilities with total gross operating capacity of approximately 3,498 megawatts, as well as a regulated utility. So just looking here, a lot of their renewable power is offshore wind and onshore wind, as well as they do have some solar. And again, you can see kind of the breakdown. A lot of revenue from Canada, some from the US, and a lot internationally as well into Europe. So generally, power producers and utilities have been a bit under pressure in an elevated interest rate environment since mid 2022, but the company fell 25% after it reported its Q3 2025 results on November 12th, just last week. So let's dig into the business a bit here to see what's going on. Now, looking at the last quarter, Q3 2025, ended September 30th, 2025, Northland's share of electricity of gigawatt hours increased 6% to 2,062 gigawatt hours, and this drove revenue growth of 13% in the quarter to $554 million, primarily due to higher production across offshore wind facilities, contribution from the Oneida energy storage facility, increased energy rates, and market demand for dispatchable power at natural gas facilities. And this increase was offset by lower wind resource at its Spanish facilities. The company also did report an impairment expense for $527 million for the Nordsee One offshore wind facility, primarily due to a transition from the subsidized price regime under the German Renewable Energy Sources Act to market pricing by May of 2027. So they will have market pricing as of May 2027, which should be a decline, as well as it will be more volatile. Now, adjusted EBITDA was $257 million, an increase of 13% compared to the same quarter of 2024, and growth like revenue was primarily from higher production at wind facilities, the contribution from Oneida Energy Storage Facility commencing operations in Q2 of 2025, and an increase from nat gas facilities. Net loss was $465 million compared to a net loss of $191 million in the same quarter of 2024, and free cash flow was $45 million, an increase of 131% from Q3 of 2024. Now, looking on a valuation basis, the business trades with a trailing enterprise value to EBITDA multiple of about 9.5 times, a trailing price to cash flow multiple of 3.1 times, and a price to free cash flow of about 14.4 times. And over the last 12 months, the company's free cash flow dividend payout ratio was 92%. This is up from about 61% for the same 12 months last year. Looking at the balance sheet, the business has cash of about $900 million. I am including their restricted cash there, debt and leases of $7.1 billion, and a net debt position of about $6.2 billion. And this provides a trailing net debt to EBITDA multiple of about 5.3 times. Now, I will say the debt load has improved over the last 5 years, as if we look back at one of our monitor reports for clients done in 2020, as we continue to monitor this business, the company did have a trailing net debt to EBITDA multiple of about 7.2 times then. If we look back at one of our reports in 2023, it was about the same level that it is today. Looking at the business's outlook, management has reiterated its fiscal year 2025 guidance of $1.2 to $1.3 billion in adjusted EBITDA, which is essentially flat for EBITDA year over year, and provides a forward enterprise valued EBITDA multiple of about 8.9 times. For free cash flow per share, the business is guiding towards $1.15 to $1.35, so $1.25 midpoint, which represents a decline of 19% from $1.54 per share reported in fiscal year 2024. and provides a forward price to free cash flow multiple of about 15 times. Now, another thing to note is that the business reduced its quarterly dividend from 30 cents per share to 18 cents per share as it looks to self fund growth projects while maintaining an investment grade balance sheet, all while not diluting shareholders. So I think that this was primarily one of the reasons that we saw the stock price fall 25% last week. Looking at some construction project updates, they do have two that are quite large that are going to be commissioned looking into 2026 and 2027. So the first here is the Hai Long offshore wind project, a 1,000 megawatt project with more than half of the wind turbines have been installed. They did note that slower than expected commissioning could impact pre-completion revenues in the amount of approximately 150 to 200 million in 2026. And the fabrication of remaining components is continuing to advance as per schedule and remains on track for full commercial operations in 2027, with overall costs aligned with original expectations. And the second here, Baltic Power offshore wind project, which is about 1,100 megawatts. In their Baltic Power project, with offshore construction activities progressing, including the successful installation of both offshore substations. The project remains on track for full commercial operations in the second half of fiscal year 2026, with overall costs aligned with original expectations. Now, the company is looking to spend $5 billion in gross capex on these two businesses on top of the already $12 billion spent. And looking forward to 2027, the business is looking at about 6,000 megawatts, which could add 600 million in adjusted EBITDA, as well as, 600 million in adjusted EBITDA, and would be growth of 48% from the 1.25 billion in guidance in fiscal year 2025. And in 2027, they're looking to add about 200 million in in free cash flow, which would be growth of about 61% from the estimated 326 million guided in fiscal year 2025. So, to conclude here, the dividend cut was a surprise for the market, now providing a forward dividend yield of about 3.9% rather than the trailing dividend of 6.6%. The dividend cut was a change in strategy as the business looks to self fund growth projects while maintaining an investment grade balance sheet and not diluting shareholders. The subsidized tariff for Nordsee 1 in Germany is scheduled to expire by May 2027, at which point the facility will transition to selling its power at lower, more volatile market pricing. The business took a 527 million impairment in the quarter due to this. Also, a reason why the stock probably took a little bit of a hit after reporting the earnings. So it is interesting to see, or it's going to be interesting to see, the impact on free cash flow and EBITDA into the second half of 2027 once the pricing changes. Guidance for fiscal year 2025, growth is relatively limited. Flat EBITDA and a decline in free cash flow. They do have those projects coming on though. Out of the business right now trades at a forward enterprise value to EBITDA multiple of about 9 times. And the business is looking to add solid growth into 2027, which if management can execute, I think that it is, reasonable, but not one of our recommendations for renewable power producers. If I was to just compare to a power producer which we have in coverage, this other name that I'm referencing has a trailing net debt to EBITDA multiple of about 2.4 times, trades at about 5 times, trailing enterprise value to EBITDA, pays about a 7% dividend yield, and would like to grow that over time. They have voiced that once free cash flow allows them to do so, and they are expecting solid EBITDA growth into 2027. So, just kind of comparing the fundamentals, I do think that a business like that maybe looks a little bit more appealing, especially when, someone's getting about a 7% dividend yield on that business. And they also, again, have good growth opportunities going forward. Now, looking at Northland, the company has an Investor Day presentation on November 20th, which should better outline the company's strategic plan and hopefully highlight their organic growth expectations going forward. But, overall, Northland is a company that we will continue to monitor at this time.
Yeah, I mean, it's a business that we definitely monitor, but the I think the average, the net debt to EBITDA trailing multiple is about 4.7, 4.8. So it, when it was at 7, it was really getting to the extreme end of that. It has, for utilities, renewable utilities or power producers. If it independent power producers, you're usually lower than that, below 4. So, I mean, it's probably still on the higher end of what we'd like to see, but we always compare them to other companies,
You
and
have
Brennan
to.
just compared them to another company there, that, smaller, yes, better yield, probably better growth. I mean, there is growth projected from Northlands, but there's growth projected from the other company we're talking about, higher dividend, likely higher growth, and it's already paid for with less debt. So yeah,
Yeah, way better payout ratio too, I'll
yeah,
also say.
yeah, all
So
those things
these are
that we
just
would look
things.
for. Yeah.
Yeah.
Yeah, that's always something which we pay attention to, is the payout ratio, whether it's off free cash flow, off FFO, off earnings, whether, because when you're looking at various different companies, you want to normally look at both the cash flow sides and the earnings sides, because they do represent different things. And here you could see that the free cash flow, when they're doing these big capex projects, it wasn't leaving enough room for them, and then they need to shift their strategy at the end of the day.
Yeah.
Yeah.